Welcome to the Byte-Size Brief. Today we are putting JPMorgan Chase, JPM, that's JPM, completely under the microscope. Let's get into it.
Yeah, it is fantastic to be here. We have a massive mountain of information to synthesize today. And honestly, the stakes for this specific analysis couldn't be higher.
They really couldn't. I mean, our mission for this deep dive is to examine the fortress-like balance sheet of JPMorgan Chase, ticker JPM, following a truly historic year.
Right.
We are looking at a huge stack of recent earnings reports, CEO Jamie Dimon's latest World Economic Forum interviews, and analyst projections ahead of the Q1 2026 earnings call on April 14.
Exactly. We've got a lot of ground to cover.
And honestly, just looking at the sheer scale of this company's recent profits, my jaw is on the floor. I mean, $57 billion in net income for full year 2025. As a retail investor, numbers like that almost don't even compute.
It is an astronomical figure.
Huh.
But, we have to stay strictly grounded in the mechanics of how that money is actually made.
Right, of course.
Because when a company's operating at that level, generating a 20% return on tangible common equity.
Wait, let's break that metric down real quick for the listener who might be, prepping for a meeting and doesn't want to get bogged down in finance textbook definitions.
Absolutely. So return on tangible common equity, or ROTCE, is basically how efficiently a bank generates profit from the hard physical cash and assets that shareholders have invested.
Okay, so stripping out all the intangible stuff.
Right, exactly. Stripping out things like goodwill, hitting 20% for a bank of this massive scale is just elite territory. It means they are incredibly efficient at turning capital into profit.
Wow.
But because they are performing so well, they earn a premium valuation in the market. And a premium valuation leaves zero room for error.
Yeah, that makes sense.
That is especially true right now, with all the looming macroeconomic and political risks that we are definitely going to unpack.
Which brings us to the core question we want you, the listener, to consider today. Is the biggest bank in the United States a safe harbor in a turbulent economy? Or is it a giant ship heading straight into a storm?
And to really answer that, we have to look at the immediate financial trajectory. The transition from late 2025 into early 2026 is critical to understanding how the bank is positioning itself for the future.
Okay, so compared to last quarter, what actually moved the needle here?
Well, if we look at the fourth quarter of 2025, the baseline results were massive. JPM posted $46.8 billion in revenue.
Which easily beat consensus estimates, right?
It did. That capped off the full year record net income you mentioned. But the biggest quarter-over-quarter shift wasn't just, organic growth from people swiping their debit cards more often. It was a major, highly strategic acquisition.
Oh, the Apple Card deal, taking over the partnership from Goldman Sachs.
Precisely. JPM officially became the new issuer for the Apple Card. We are talking about acquiring roughly $20 billion in credit card receivables. And they bought that massive portfolio at a discount of about $1 billion.
But taking on that portfolio wasn't free. I was digging through the Q4 numbers, and I saw what looked like a pretty massive initial hit to their profitability.
You were referring to the credit loss reserve provision?
Yeah.
To safely absorb this new portfolio, the bank had to set aside $2.2 billion in the fourth quarter.
Let's explain what that actually means mechanically.
There's a credit loss reserve is basically the bank taking cash and locking it away in a vault. They are legally and financially anticipating that a certain percentage of these new Apple Card holders will inevitably default on their debt.
So they literally can't touch that money.
Right. Taking that $2.2 billion chunk out of their usable cash momentarily dinged their GAAP earnings per share, generally accepted accounting principles, bringing it down to $4.63 for the quarter.
So basically, it's kind of like buying a used premium sports car at a discount, but having to immediately drop $2.2 billion on new brakes before you can even drive it. How is taking on all this credit risk a win for regular JPM investors?
Well, it comes down to...
Because, wait, let me push back even further. Goldman Sachs literally bled billions trying to make the Apple Card profitable because the user base is notorious for high charge-off rates. Why does Jamie Dimon think he can magically fix a portfolio that Goldman couldn't?
That is the exact skepticism pushing against the stock right now. But the answer really lies in scale, infrastructure, and long-term compounding.
Okay.
Goldman Sachs had to build a consumer credit card platform from scratch. They didn't have the historical data models or the massive collections infrastructure to accurately price subprime risk.
But JPM does.
JPM does. By absorbing more than 10 million Apple Card accounts, it cements JPM as the undisputed #1 U.S. card issuer. That is a strategic moat.
So they are taking a short-term hit to establish a permanent monopoly-like scale.
Exactly. They're playing the long game. They are actually forecasting a massive $103 billion to $104.5 billion in net interest income for 2026.
Let's define net interest income, or NII, because that is really the engine of the entire bank.
Net interest income is simply the difference between what the bank pays you in interest for holding your deposits and what they charge a borrower for a mortgage or a credit card. It is the spread.
Ah, got it.
So this $20 billion Apple Card portfolio becomes a high-yielding asset that feeds their net interest income compounding machine for years to come.
Right, so they've just bolted on 10 million digital-first, tech-savvy Apple Card users, but, I mean, you can't just absorb that kind of tech-heavy volume on legacy banking servers.
No, you really can't.
If you want Silicon Valley customers, you need Silicon Valley infrastructure, which explains why their tech budget this year looks way more like a tech giant's than a traditional bank's.
It requires an unprecedented level of computational power. For 2026, JPM has allocated a colossal $19.8 billion technology budget.
To put that $19.8 billion tech budget in perspective for you listening, JPM is spending more on technology in a single year than the entire market cap of companies like Expedia or Pinterest.
It is wild when you frame it like that.
They aren't just funding an IT department to fix broken printers, you know?
Yeah.
They're funding a standalone tech empire inside a bank.
And what's crucial to understand is the specific allocation within that budget. They are increasing their AI-specific spending by $1.2 billion,
Wow.
bringing the total dedicated AI budget to $2 billion for the year.
This makes complete sense when you look at the competitive landscape. I remember listening to Jamie Dimon at the World Economic Forum in Davos.
Oh, right, the Fintech comments.
Yeah. He made a really surprising admission for the CEO of the world's most powerful bank. He flat out said that fintech companies like Chime, Revolut, Stripe, and PayPal had essentially beaten them in certain payments areas.
He actually said they got their asses kicked.
Yes, exactly.
It was a rare moment of vulnerability, but it completely explains their current aggressive posture. They recognize the existential threat of agile fintechs stripping away their payment processing fees, and they just poured capital into fighting back.
And is it working?
It is. In the fourth quarter, their payments division generated a record $5.1 billion in revenue. They are building a technological moat so wide that smaller players simply cannot cross it.
And they're leaning into AI incredibly hard to build that moat. I read they already have about 450 AI use cases in production.
Yeah, and Dimon wants to push that to 1,000 by the end of 2026.
And we aren't just talking about chatbots here. They are using Agentic AI.
Agentic AI is the key differentiator here. Instead of just, answering a question, an Agentic AI takes action. It drafts investment banking presentations, writes complex M&A memos.
It automates millions of daily trade settlements. But if you're listening to this and checking your own Chase app, you might be wondering why you care about their Agentic AI back office integration.
Fair point.
Well, as we saw recently, it isn't completely frictionless. There are active Reddit threads swarming with customers complaining about the bank's AI. Apparently, these new algorithms are flagging accounts for suspicious activity and abruptly closing checking accounts entirely without any human review.
Right.
Customers are getting locked out of their own money, confused and frustrated. That's the real friction of this transition.
Which highlights the very real risk of over-automation. When an algorithm operates as a black box, meaning even the engineers aren't entirely sure why it made a specific decision, it can create severe reputational damage.
And legal noise, too. The bank even faces a $5 billion lawsuit filed earlier this year regarding these improper automated account closures.
Exactly.
Hold on, how does that actually affect JPMorgan Chase, JPM's stock price for regular investors like me?
Well, it comes right back to the bottom line. The AI push isn't just about flashy tech or keeping up with Silicon Valley. It is mathematically projected to drive $1.8 billion to $2.7 billion in annual back-office cost savings.
Because they don't have to hire as many human analysts and compliance officers.
Exactly. If they can reduce their massive $90 billion expense base by even 2 or 3% through automation, the return on investment for that $2 billion AI budget is incredibly strong.
I see.
It mechanically boosts earnings per share for shareholders.
Okay, let's unpack this. The tech infrastructure is practically a fortress. They're spending $20 billion a year to keep it bulletproof.
Right.
But the broader economy is entirely out of their control. No algorithm, no matter how advanced, can completely protect JPM from sweeping government policies and macroeconomic shocks.
That is the vulnerability. And this is where the external environment becomes the primary risk factor. Jamie Dimon was very vocal about this at the World Economic Forum and in his recent annual shareholder letter.
Yes, he offered some very stark warnings. And to be clear to our listeners, we are looking at this purely through the lens of economic risk to the bank, maintaining total impartiality regarding the politics themselves.
Of course.
Dimon stated that he agrees borders need to be controlled. However, he warned that the newly proposed 10% tariffs have actually bumped the bank's internal probability of a U.S. recession from 40% up to 60%.
That is a significant jump in probability.
Right.
We have to look at the mechanism of a tariff. A tariff is effectively a tax on imported goods.
Right.
When companies pay that tax at the border, they pass the cost onto the consumer, which immediately drives up inflation. He had a very memorable quote about this.
America first is fine, as long as it doesn't end up being America alone.
Exactly. He is stressing that maintaining global economic alliances is structurally essential for a stable banking environment.
He also weighed in heavily on the proposed 10% cap on credit card interest rates. He didn't mince words. He called it an economic disaster.
Let's break down why that is. If a bank is forced to cap credit card interest rates at 10%, but the mathematical default risk for a subprime borrower requires a 15% rate just for the bank to break even.
The bank physically cannot lend to them without losing money.
All right, they don't just generously lower the rate, they simply stop issuing the cards entirely.
Which is why he argued that capping rates at 10% would effectively remove credit access from 80% of Americans. The risk profile just wouldn't make sense for lenders anymore.
He even suggested the government test it out in just 2 states like Vermont and Massachusetts to see the real-world fallout before rolling it out nationally.
Wow, a 10% cap across the board. I mean, think about what that does to global trade, right? If consumers stop buying because their credit is cut off, the whole global supply chain just grinds to a halt.
Right, but what does all that actually mean for JPMorgan Chase, JPM investors?
Good point. Let's bring it back to the ticker.
The primary concern for investors here is the two-sided risk to that $103 billion net interest income guidance we talked about earlier.
Okay.
That massive revenue guidance relies on a very specific macroeconomic assumption that the Federal Reserve will cut interest rates twice in 2026.
Because if they cut rates, the bank pays less to depositors, widening their profit spread. But if tariffs drive inflation back up...
But the Fed cannot cut rates. If rates stay high to fight inflation, mortgage and corporate loan growth could stall.
That makes sense.
More importantly, in a recessionary environment, consumer credit deteriorates quickly. Let's go back to those 10 million new Apple Card users.
Oh, right.
They historically have higher than average charge-off rates. If the economy actually tips into that 60% recession probability, credit card delinquencies could spike across the board.
And that initial $2.2 billion reserve vault they set aside might not be nearly enough to cover the actual losses.
Precisely.
So with a 60% chance of a recession looming, it makes total sense that investors might be getting a little anxious. But the bank hasn't just been sitting on its hands waiting for the storm to hit.
No, they certainly haven't.
They have prepared a massive financial cushion to weather it.
The capital return program they have outlined is one of the largest in the history of global finance.
Let's look at the numbers because they are just staggering. They just authorized a brand new $50 billion share buyback program.
Massive.
On top of that, they are paying a $6 per share annual dividend. And they are currently sitting on roughly $60 billion in excess capital above their required regulatory minimums.
And there is a potential regulatory tailwind on the horizon that could expand that cushion even further. In March, the Federal Reserve proposed a 4.8 percentage point reduction in the GSIB capital requirements.
Let's translate GSIB for the audience really quick.
GSIB stands for Global Systemically Important Bank. It's essentially a regulatory scorecard.
Okay.
Depending on your score, regulators force the world's most critical banks to hold an extra layer of capital padding, just in case everything goes wrong. The Fed is proposing to lower that required padding.
Meaning JPM can take tens of billions out of the proverbial mattress and actually put them to work through even more buybacks, bigger dividends, or aggressive lending. Let's talk about the buybacks, because that mechanism is crucial. Think of that $50 billion buyback, like a massive structural floor under the stock price.
That's a great way to put it.
Right. If the market panics over a recession and investors start dumping shares, the bank steps in as the ultimate buyer of its own stock, absorbing the sell-off.
Yes.
By buying and retiring those shares, they artificially reduce the total share count, which mathematically props up the earnings per share, even if actual profits are flat.
It is brilliant financial engineering, and it provides immense stability.
But there's a lingering shadow over all of this stability, the ultimate uncertainty. Leadership succession. Jamie Dimon is 70 years old.
He is.
He has steered this ship through the 2008 financial crisis, a global pandemic, and regional bank failures. But recently, the architecture of his executive team shifted.
Right. Daniel Pinto, the president and chief operating officer, stepped down and is retiring.
And Jennifer Piepszak, who many analysts thought was a frontrunner, has publicly opted out of the CEO race entirely.
That leaves a two-horse race between Marianne Lake, the CEO of Consumer and Community Banking, and Troy Rohrbaugh, the co-CEO of the Commercial and Investment Bank.
Which creates a uniquely uncertain moment for a company that prizes institutional stability above literally all else. Both Lake and Rohrbaugh are highly capable executives who have run massive divisions.
But neither has sat in the absolute top seat of a globally systemic bank during a potential recession.
So if we go back to our analogy, we have a $50 billion structural floor under the stock price. But if Dimon leaves, doesn't that structural floor lose its best architect? I mean, Dimon is famous for his flawless timing on when to aggressively deploy capital. Does the premium valuation of JPMorgan Chase, JPM, hold up without him at the helm?
It is the multi-billion-dollar question that every institutional investor is asking right now. However, the operational evidence suggests that the fortress balance sheet and the ruthless operational discipline are fully institutionalized now.
So it's not just the Jamie Dimon show anymore.
Exactly. You could look at how they handle their regional bank acquisitions to see this in action. The recent news regarding the layoff of 99 First Republic employees in San Francisco is a perfect mechanical example of this discipline.
Right, they bought First Republic when it collapsed. They kept some key staff on during the transition to ensure the clients didn't flee, but as soon as the technical integration was complete, they made the cuts.
It proves the bank is ruthlessly efficient at integrating acquisitions and stripping out bloat to maintain their profit margins, regardless of who sits in the CEO chair.
Yeah.
They do not keep back-office roles in high-cost areas like San Francisco if they don't mathematically have to. The machine operates on a very strict set of financial principles that are designed to endure far beyond Dimon's tenure.
So, synthesizing all of this for you listening, we are looking at a profound core tension. On one hand, JPMorgan Chase, JPM, is a compounding profit machine with unrivaled monopolistic scale. They have absorbed a massive new tech-savvy consumer base via the Apple Card. They have a $50 billion buyback cushion to prop up the stock, and they are leveraging Agentic AI to strip out billions in legacy back-office costs.
But on the other side of the ledger, they are facing a self-reported 60% probability of a recession, extreme sensitivity to the path of interest rates and inflation due to the Apple Card integration, and the looming, untested transition of the most famous and trusted CEO in modern banking.
It's a fascinating dynamic, and it leaves us with a final provocative thought to mull over as we watch this play out. As the bank deploys Agentic AI across its trading floors, fully automates its back office, and aggressively phases out legacy human roles to the tune of a nearly $20 billion tech budget.
Yeah.
At what point does JPMorgan Chase, JPM, stop being evaluated as a traditional slow-moving bank and start being valued by the market as a global technology company that just happens to have a banking license?
A tech-level valuation multiple is exactly the re-rating the executive management team would love to see. It changed the entire math of the stock.
All right, listeners, what's your take on the future of JPMorgan Chase? JPM, are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.